Thank you, Mr. Chairman. Mr. Powell, as you know, when the COVID-19 pandemic started, the Federal Reserve began a round of quantitative easing, referred to as QE4. Like many COVID policies, this program dragged on, not ending until March of 2022. To conduct this program, the Federal Reserve expanded its balance sheet with short-term interest-bearing liabilities on one side and long-term interest-bearing assets on the other. And this was at a time of historically low interest rates. When predictably expansionary fiscal and monetary policy sent inflation to the highest level in 40 years, the Fed was forced to raise interest rates rapidly. Now, going back to one of my colleagues' questions about the bank losses and the result of that being poor management and failing to hedge against the interest rate environment, is that a fair summation that management and failure to hedge is what caused some of the bank losses?
Certainly, many banks managed the interest rate risk that came along through that technique.
But some did not, is that correct?
Some did not.
In October, the Fed suspended its remittances to the Treasury due to losses. Mercatus Center estimates that the lost revenue for the Treasury will result in $760 billion over the next 10 years. And so it does concern me that Treasury is blaming banks for mismanagement when you yourself had to stop remittances and will suffer losses. Now, when the Fed prepared its and I said Treasury Fed, but semi-annual monetary policy reports through the time of QE4, none of those reports mentioned interest rate risk would impact the government's finances. Should that have been disclosed, or did the Fed not understand its own risk in correlation to the interest rate environment?
Well, so what we do, we remit all of our profits, right? And in the era of QE, those profits were enormous. We remitted something like $1.2 trillion in profits to the Treasury Department because we're funding purchases of long-term assets with issuance, as you pointed out, of overnight lower rate instruments. So in a way that's what was happening during the QE era. As we now enter an era of raising rates, that'll turn around a little bit. But ultimately, though, we don't manage at all for fiscal reasons. What we're managing to is maximum employment and price stability, and we're using our tools to achieve that. So we don't think of ourselves as trying to attain some kind of fiscal goal one way or the other.
But what about as far as, well, I guess I'll ask this question. When you look at the roughly $700 billion in blow to the Treasury, how's that going to impact the President and Congress's kind of economic plans and policies going forward? I mean, is it going to impact negatively?
It's not. It doesn't affect spending, right? It doesn't affect. Congress appropriates money, the executive branch spends it. It affects. It will mean that more borrowing has to take place, and that could raise rates very marginally at the margin. But that's how it would affect the budget, but it wouldn't be a major effect on the budget.
Well, I didn't ask about the budget moreover than our overall economic goals. And I think what I think a lot of us are getting at is when you look at Main Street America, when you look at mortgage rates and how it's impacting, families' abilities to get a mortgage. And so someone who was eligible for $300,000 to buy a home now is no longer eligible for that home. You have people that are now upside down due to this, expansionary, interest rate environment. And I have concerns about future raises and the impact that's going to have on small businesses, availability of credit, and again, your average homeowner. And the people that pay that or bear the burden of that are your lower income and your middle class families. Now, when you look at Silicon Valley Bank, which is supervised by the Fed, again, I get back to when you look at the interest rate increases, why there was not more warning or hedging from you as the impact it may have on the fiscal system, the financial system, and the banking system, because as we've well acknowledged, both sides of the aisle, that there was some poor management, but the regulators and the communication from the government was lacking. And Mr. Chairman, I am out of time. Mr. Powell, thank you for being here, and I'll yield back.